Hi, welcome back to Growth Talk. I'm John Early here with Tony Sanchez. How are you doing, Tony?
I'm doing good. How are you, John?
It's been a good week. This week we've had several reports come out on inflation, the consumer price index, retail sales, and also industrial production. And we're going to talk about how those relate. We're going to start talking about the retail sales. Retail sales went up, wasn't it 0.7%? From the month before. That's a fairly good monthly increase, but it's down substantially from the high in April. And what happened with that high following the COVID recession, retail sales have been on an absolute tear, and they spiked higher, way above the growth trend of the last expansion. And even though then they've come down since April, even though they're up a little bit this month, they're probably going to trend down towards that longer term growth trend. And that doesn't mean trouble for the economy, but it's, we probably just kind of overdid buying things in the aftermath of COVID with all the stimulus checks going out.
I feel like there was a little bit of an uptick from last month concerning school just starting up again, and I feel like year after year that around this time of the year that people are buying, they're having to go to school for school supplies, clothing, anything and everything for to get their kids ready to go back to school.
Generally, these the series on retail sales is seasonally adjusted. So if this school season was bigger than previous school seasons, that would have an uptick, and maybe that was part of it. But as a general rule, it would only have an impact if this school season was a bigger boost than going back to school usually is, and that very well could have been the case. And
right, especially with COVID last year, some different areas of the states they had they were putting off the going back to school right away. In some areas went back to school right away. So I think there might have been a little bit to do there.
Yeah. And one of the things on inflation, we in the last 7 or 8 months, or 6 or 8 months, we've had a huge spike in inflation. In fact, the 6-month rate of inflation through July of this year was the fastest 6-month rate of price increase since 1981. The year-over-year rate is down 2 months in a row. It was down in July and it was down in August. A surge in retail sales roughly corresponds with a little bit of a lead time on the huge spike in the price index over the last 6 months. And adding to that spike, there was a big supply disruption in industrial production when after most of Texas shut down for a couple of weeks in February, along with a good part of the Midwest. There was a big drop in industrial production. And then in the months after that, when supplies were diminished and there were shortages of lots of things. In fact, they're still catching up on shortages of plastic production and polyurethane production that were from plants that were shut down in Texas. And so those supply shocks are, along with that huge surge in retail sales, contributed to that spike in inflation. That spike in inflation is probably, or most of the spike is temporary and is going to pass as those supply disruptions work their way through back through the economy, and as retail sales probably back off towards the longer term trend. The long-term inflation rate probably isn't going to stay at this high level. It's probably going to trend down.
Federal debt ceiling is becoming a debate again between the Republicans and Democrats. The Democrats obviously wanting to raise it, and the Republicans not wanting to raise it, or not necessarily not wanting to raise it, but they don't want to, in regards as it just allowing a right of way for Joe Biden's infrastructure bill to go through. What are your thoughts on that?
I think you're right. both parties are jockeying to make the other party look bad and to extract concessions from the other party. And typically the party in power who has to deal with funding the government is more eager to raise the debt ceiling than the party out of power, especially when Republicans are out of power. They're very reluctant to raise the debt ceiling unless they get significant concessions from the other party. It's kind of like a game of chicken where you're on this collision course where if you don't raise it and continue to run the government, horrible things eventually happen. 10 years ago, when there was, we played the game of chicken a little too long, and the U.S. lost its AAA credit rating with Standard and Poor's because they thought, the government doesn't have a reliable mechanism to fund itself. And the U.S. is the only country in the world that has a debt ceiling where the government, essentially holds itself hostage. And it's kind of a problem, but we've dealt with it since the 1930s. And in the last 60 years, since 1960, we've had to raise or suspend or somehow alter the debt ceiling 78 times. So 78 times in 60 years, we've dealt with this issue. But it's gotten more controversial the last few decades, and it's become more of a political football or gamesmanship or even brinksmanship. And hopefully there'll be some kind of compromise before serious consequences happen. But with the divisions we have politically right now, it's really hard to know what might eventually happen. And there is kind of a debt problem. Since 1981, we've been growing the debt faster than the economy. Or at least that's been the trend. It doesn't happen every year. And at the end of the fiscal year 1981, which ended in September of 1981, the national debt was down to 31% of GDP. And in the second quarter of last year, it hit 135% of GDP. And then in 3 of the 4 quarters since then, GDP has grown faster. But it's still a pretty high level of debt. And if we're going to, the solution is to grow the economy faster than the debt. And I think that's what fiscal responsibility is. You have a combination of tax policies and spending policies that encourage more economic growth than debt growth. And the debt isn't necessarily bad. A lot of it depends on what you do with the money that's borrowed. If it's public investment that increases the productive capacity of people or creates or builds infrastructure that enables greater growth, then debt can be, part of the solution.
Who is America in debt to?
Well, a lot of the debt is to Americans themselves. Right now, a good portion of the debt is owned by the Federal Reserve. And when the Federal Reserve buys debt directly from the Treasury, it's the kind of the closest thing we have to printing money. When the Federal Reserve buys the debt, they do it based on a belief that that's the best thing for growing the economy. And if the Fed doesn't buy it, then if we run a trade deficit, the nations we have a trade deficit with, they'll end up buying assets. A lot of our debt is owned by China. Back in the 80s, a lot of our debt was owned by Japan when we were having big trade deficits with Japan. Americans, it's owned by pension funds. It's owned by investors. It's owned by foreign interests, and of course the Federal Reserve. And then the Social Security Trust Fund, their main investment is in government debt. The main part is we need to figure out how to grow the economy faster than the debt, like we did from 1945 through 1981. In the period where we were growing the economy faster, in that 1945 to 1980 period, the top marginal tax rate averaged 81%. And in the 1981 to 2020 period, the top tax rate averaged 9%. And growth was a lot faster in the earlier period as well. And so part of the solution is having a tax structure that doesn't encourage unproductive tax avoidance, but encourages productive tax avoidance, where the people who run the biggest corporations have plenty of income from their businesses, but they have incentive to plow most of the revenue from business back into growing businesses in the economy rather than taking extravagant incomes like we've done over the last 40 years. Back on inflation, there's one of the areas of concern on inflation that's getting some buzz is how much meat, poultry, and egg prices have gone up over the last year. It's like a 8% increase. And that sounds like a lot, and it is, but those prices are pretty volatile. I mean, there were 2 times during the last expansion where the year-over-year price increase in that food index was over 8%. And so right now the trend isn't that spike isn't out of proportion to previous expansions, but we'll want to watch it to see if it continues. Overall, the rate of inflation in food is just like 3% year over year. So the overall rate isn't terrible, but there are parts of it, especially in the meat and poultry and eggs index, where it has spiked substantially. And a lot of that was disruption to supply because of COVID. I mean, there was a period back a year ago where the meat packing plants were closed down because of COVID, and farmers were having to slaughter animals without them going to market because they didn't have a market for them. And so there are some supply disruptions that went on that made this spike bigger. But probably over the next year, that inflation rate in meat and poultry is not going to continue. It's probably going to back off.
Right. I mean, there already is a bunch of volatility when it comes to those markets, as you know, pertaining to weather and stuff like that too. So I think it is just a kind of a blip, and hopefully it goes away soon, because I do like me a mean steak.
Yeah, steak is kind of expensive right now. I hope I at least hope the price doesn't keep going up.
Me too. Thank you again for joining us on this week's Growth Talk. Go ahead and give us a follow on our Facebook. We did do a blog post this week going more in depth about our federal debt ceiling crisis that's going on. I appreciate you guys, and we'll see you next week. Thank you.
All right. Goodbye. See you next week.